Okay guys, trading psychology. This is one of the bigger things in trading in terms of things that affect you. Now, there's no right or wrong way to do this, in the same way that everybody has their own opinions, their own things that make them tick, and their own things that matter to them. So there's no point in me saying this is how you do it. But what I want to try and illustrate here is different ways of thinking about the way you go about trading. So the psychology aspect links quite well with risk and the way you think through what's happening, the things that affect you. The culmination of this, and what we're going to look at, is sort of rational choice and prospect theory, and then we're going to look at cognitive biases as well, the things that influence your decision making, with the view that you're going to be much more better equipped now to be able to define what it is that does affect you. And if you can put a name to it, if you can understand those situations, you can then formulate ways and means to deal with it. That's the way to try and think about this. What I would never say is you should try and change the way you think, change your psychology. I'm not qualified to do that. My job is to understand the things that affect you as a trader, the things that affect me as a trader. That's the stuff that you want to understand. I'm not trying to suggest you should change the way you are. Everybody has their own ways of doing things. And in trading, you can apply the way you do things in a way that is going to produce results. You've just got to find the situations that suit you. And a lot of that comes down to understanding your psychology, also understanding market psychology as well, because there's a herding aspect in markets, and that's part of human nature, part of psychology. So let's go and have a little look at this. What we're basically going to be looking at is why it is that economics doesn't always work, which is the basic idea that market participants, whoever they may be, are uniformly rational. And so what they do, they price events perfectly. Everyone makes decisions in a perfectly rational way. Now, I'll explain the concept of rational choice in a moment and the sort of basic tenets of that. And that is what is assumed everybody makes their decisions based on. Now, the reality of that simply isn't true. And it's very easily evidenced, without knowing anything about psychology, in overextensions, bubbles, crashes, those types of things. If people were perfectly rational, you wouldn't have that, because everyone would recognize a bubble as a bubble starts, and therefore it would never be a bubble. So people are not perfectly rational. There's one thing to take on all the available information. There's then another thing to understand how people are positioned, because people trade relative to their situation, relative to the prospect of what's coming next, not relative directly to the available information. That's a really important concept to try and grasp. Basically, people are not rational. People will make decisions based on other factors that are outside of the sort of defined, rigid rules of rationality. Basically, people are subjective. Now, you can learn objectivity to a degree, and that's one of the things that, technical analysis and planning trades and having a very clear structure to your trades does for you, because that teaches you objectivity. That also plans objectivity into a trade, and that's a really useful thing, because this circumvents the subjective, oh, but it might do this, oh, there's a seller, so therefore I should get out of a trade. It gets around that because it says this is the structure, this is what you're looking for, this is your expectation, this is what you do. But people are still subjective, and there are external factors that affect anybody's decisions. There are external factors that affect every trader's decisions, and that is also something that gets factored into markets, and that's something that uniform rational choice does not factor, because that's hard to quantify, because no two people are exactly the same. People get influenced by fear and greed's the obvious thing that people mention, which is to a degree true. The people then try and hold a trade longer than is necessary because they just want that little bit more out of a trade. They fear the trade going wrong, so they get out of trade, which again makes an irrational reason to buy, for example. All these things you can say are irrational, but they are emotions, and they factor in as well. Pressure to perform. This is something that factors in a lot, and you see this with many traders. As the further they get into their career, the pressure to perform increases, typically because their level of responsibility grows. I certainly felt that when I went from being single and living a pretty carefree life to then having a girlfriend and then wife and then children. The pressure to perform grows, because simply there is more responsibility laid on you. Now, don't get me wrong, my wife's successful in her own right and very successful, so it's not a financial pressure to perform. It's the fact that it is a pressure in the sense of what it is that you want to be doing. The external responsibility that you'll portray to people as well is important, and that's important to people. But for all the subjectivity that individuals face, crowds do the same. And what crowds create in terms of subjectivity is often a sense of FOMO, a fear of missing out, the necessity for everybody to do the same thing, this herding. It's safer in a crowd, and that's part of human nature. That's part of most of evolutionary nature. That's why you still see it with animals. They all stand in crowds. Why? Because it's safer to be in a crowd from a macro perspective. If you're in a group, your probability of being the animal that gets attacked goes down, because if there's 1,000 of you, you've now got a 1 in 1,000 chance, whereas if there's 2 of you, you've got a 50% chance. And that's the simple logic of herd mentality. And so crowds will herd. People will herd together. And particularly when opportunities get smaller, what happens is trades get more and more crowded, more and more compressed. And this is an illustration of that herding mentality. What happens here is post the Donald Trump election, equity markets rally for various different reasons on tax cuts, etc. But volatility gets compressed and has been getting compressed throughout 2015, 16 and 17. So what then happens is every time volatility increases, it is immediately slapped back down. And what that does is it herds positions together. You get concentration of positions. Why? Because there are less opportunities due to the lack of volatility. And those opportunities are smaller in payout and have a greater number of people all trying to do the same thing. So they effectively cannibalize themselves, and in doing that compress to a point that they then have this explosive outcome in the other direction. So whilst there is a sense of safety in crowds and a safety in a herding or concentration of positions, in fact there is a major risk here that once this turns over, now everybody's looking in the same direction and everybody has to run in the opposite direction for the exits. That's what ramps the volatility up. That's what creates movements like this. That's not necessarily a bubble, but it's a similar type reaction. You get a bubble that builds where everybody feels they have to be in the same thing. The opportunity there gets lower and lower and lower and lower. The payout gets smaller because as the bubble matures, it will continue onwards. The last person holding the can is the one who ends up in trouble, and then you get the reversal. And that's all to do with market psychology of concentration of positions, trying to make sure that you're not missing out on something because everybody else is doing it, and that's the only game in town. So you can see then, prime example of market psychology and the subjectiveness of markets. Now, theoretically, there is rational choice and everybody should be acting in a certain specific way. Now, the rationality of some of these concepts makes a lot of sense, and it is something that you should be thinking about when you're taking trades on. So I would not dismiss this, because to go against some of these ideas is essentially irrational. People can be irrational, and you can be irrational for certain reasons, and I'll explain that in a little bit when we talk about utility. Right, but what I've tried to do is turn this into trading related. Now, there's a fantastic book on rationality by Steven Pinker, who talks through the entirety of rational choice and various other aspects of rationality, because this is the perfect theory to rationality. And it has certain tenets to it. One, being commensurability. That you have a preference at any point in time. And when you apply this to trading, at any point in time, you have a preference. To say you don't have a preference effectively means that your preference is to be flat. But everybody has a preference given a certain subject at any point in time. That's something to bear in mind. It's something that is part of the idea of rational choice. So effectively, when push comes to shove, you do have a preference. Even if it is only a marginal preference, you do have a preference. Transitivity. This is the concept that based on your preferences, you can't then have a preference to one thing and then a preferred preference in the other direction. So what I mean by this is if you prefer to buy over being flat, and you prefer to be flat to selling, then you must prefer buying to selling. And where this comes into play is the idea that what happens is people will get to a level where they say, I want to buy. So therefore, the choice is I'd prefer to be long than I would to not have a position, which is what you have to start with. But then what will happen is people say, well, I'll buy, but I might sell. And that means that you have this perpetual cycle where you're doing something irrational. If you would prefer to buy than to have no position, then you can't prefer to sell than to buy. It doesn't make rational sense. So if you want to buy rather than be flat, then you'd want to be flat rather than sell when you get there. You can't then make the decision at the level to now sell, because that implies you prefer to sell than to buy, which makes no sense, because there's a stage scale along the way. So that's irrelevant. You're not going to be able to prefer to sell than buy if the option is to be flat. So what this helps you with is something I've talked about before, what I call your cake and eat it trade. Your choice when you get to a level is to buy or to be flat. You then have a choice that if it doesn't offer you the option to buy, you'd prefer to be flat than to sell. So therefore you cannot sell the level if you originally planned to buy the level, because that was your first preference. Closure in rational choice is the idea that choices have defined probability. Now in trading, this is tricky because this implies there is a closed game. Now in trading, it's not a closed game and probabilities change. This is where trading does start to fall out of the realms of rational choice, and so therefore markets are not perfectly rational. But theoretically, if you buy, you have a probability of win calculated by your own judgment on previous experience, and you have the converse probability of a loss. So you have risk, not uncertainty. So you do have closure on your trade. That you're not in a situation where you don't know what's going on. You're in a situation where you know that if you buy, you have a probability of X result and the converse probability of Y result, the loss. So you have closure, even if it's a risk that you have defined as a Bayesian probability, that you don't know, you can't define this precisely as a probability, but your probability is your essentially conviction assigned to this trade. So what you have then is known unknowns. You have risk that you know that there are some unknowns out there, and that's what creates risk. You do not have unknown unknowns, which is where you don't know what the risk is and you don't know what the result of that risk might be. That's not something you have with trading. It is definable, and you can then have closure on your decisions. Independence is part of rational choice. What independence is all about is the idea that certain information is irrelevant, which comes back to transitivity. If you prefer to buy over being flat, then the option to sell is irrelevant. It should not feature. Your choice is buy or flat, and that is it. The other options do not feature in this. So this creates independence. There's a story about one of the big sort of proponents of rationality and logical thinking, Morgenstern, who uses the analogy of he is in a restaurant and is given the choice of apple pie or blueberry pie. And whilst making that choice, and he's decided for apple pie, he is then presented with the specials, of which the waitress says, "Would you like cherry pie?" And he responds, "No, I'll change to blueberry." This is a good example of irrational information. The relevance of being offered cherry pie when you have already decided that apple pie is preferable to blueberry can in no way mean that you now change to blueberry. You could change from one to the other, but that was never your original decision. So you should stick to apple pie. That's the example used there. I've tried to tell that as well as I could, possibly not as well as it might be. Consistency. This is important when you're in trades, and this is something that people don't always do. If you prefer a win to a loss, then you must prefer a chance of a win or loss. That's got to be more appealing than settling for a loss. What I mean by this then is the idea that if you can win on a trade, then that is a preferable choice. Of course, you may well lose, but what you don't want to do is get into a trade, still have the possibility of winning, and get out of the trade because you don't like it. You can create the probabilities, you can recognize the risk that you have on a trade. So what you don't want to do is then just get out of the trade to make sure that you don't lose more than X, because you would prefer the possibility of winning to losing, or the possibility of a win or a loss, because that implies closure on the trade, rather than just settling for a loss, just getting out because it doesn't quite look what you want it to be. And then finally, interchangeability. That what you're considering here is what's desirable versus what's probable. So if you have a 99% chance of a win versus a 1% chance of a loss, this means that this is desirable. And it's interchangeable for probable. You should want this because there's a 99% chance of a win. As the odds start to shift, theoretically, this should become less desirable, and the option to be flat should become more desirable. So what this is basically saying, that as your probability deviates away from 99% chance, then you should be more inclined to be flat on a trade than you should be to be anything else. And the lower the probabilities go below 50%, the more you should want to not be in the trade at all. or sorry, even be going the opposite way, because then the probabilities shift in the other direction. So it's less about loss or win, it's about buy or sell in that sense. So hopefully that gives you a sense of the way to try and think about rational choice when you bring it into your trading. But rational choice does not factor into everything. Theoretically, rational choice is about maximizing value. Now, this does not make any sense when we look at an example of gambling. In gambling, these are closed games. So there are known knowns in a closed game. You know what the risk is, you know what the outcome can be. So all aspects are defined here. So you can then work out the expected value of playing certain games. Now, I'll go into the details of the calculations of the rules behind craps and the rules behind roulette. But what you can see here is both have a negative expected value. 0.17 for craps, 0.05 for roulette. So roulette is a better choice. So to maximize value, you play roulette. But neither of them is a rational choice, because rationally, you would not choose anything that provides you with negative value. So why do people play? Emotions. Subjectivity explains why people play, because what people do and what happens is you place value on the subjective aspect of the enjoyment of playing. Everybody knows these things. Everybody knows the fact that each of these games have expected value. This is how a casino makes money. But people still play. And people play for two things. One, enjoyment, and two, the prospect of a big win. Because it's not the big win necessarily that they're after, it's the heightened sense of satisfaction of getting that win. And that's the subjective aspect that can't be qualified by or quantified by rational choice. And that's where rational choice falls down. Now that's a closed game, and people still play a closed game knowing perfectly well that this is not a high value strategy and you're not maximizing your value in any way by playing them, apart from your utility, which is your satisfaction. Now trading isn't a closed game. There are known unknowns. You know that trades can go wrong, but you don't know by how much they can go wrong or right. And so value ultimately is not necessarily your main objective. You have to maximize utility. This is the psychological side of things. If it was just about maximizing value, you would define precisely how you do that, and that would always be your objective. But it's not. And this comes into the way that you operate as a person. You have to maximize your utility, which in many senses goes against rational choice and creates situations where you actually make an irrational decision, theoretically irrational decision. But this serves the purpose of not impacting future decisions. So the utility of getting out at one point is not necessarily rational, but it prevents the negative utility of a further situation. I'll give you an example of this one. We used to, in the office, run a syndicate on the lottery. And we would generally only play when the lottery results rolled over, so you had a huge jackpot. Now, playing the lottery has a negative expected value. Theoretically, you should not play it. But knowing that there is a syndicate running, i.e., if the ticket wins, the rest of the office overnight is going to win millions of pounds, the irrational choice is to actually buy into the syndicate. Because what you're doing is you're protecting your utility of being the only person who does not win the lottery. So you're insuring yourself against the negative psychological impacts of being the only person in the office who doesn't win the lottery. Now, playing the lottery is an irrational choice. So nobody should be doing it. But because some people are doing it, you maximize your utility by doing something irrational. Because the cost to you of playing the lottery is limited, the utility cost of not winning the lottery when everybody else does is huge. So you insure against that by making an irrational choice. And that's part of the thing that has to factor into the way people go about trading. So we'll go and explore the emotions in a trade and look at how they affect some of the decisions that people make. Okay, so where do the emotions come from in a trade? Well, a lot of it essentially comes back to an evolutionary response, an evolutionary and a physiological response. Now, for anybody who's read anything or received any cognitive behavioral therapy, you'll understand some of these concepts and you may know a bit about this stuff. But basically, the emotions that you have, a lot of them are hardwired, and particularly ones that involve the consideration of danger, which you can interchange for risk or interchange for loss. Essentially, there is an evolutionary response which has been very helpful for human beings over time to try and mitigate danger. And so as soon as danger appears, there is a response very quickly to get away from it, to fight it, or to freeze, because that might help you that whatever the danger is going to not notice you. And this all comes back to essentially danger was physical for a long part of our evolution. Now, in modern life, and in particular in trading, there is no physical danger. So when you put a trade on, there is no physical danger to you. Yet your response, because you emotionally see this as a danger, this is a risk to your financial situation, you see this as a danger, and you then create this physiological response. Essentially, what happens, in practical terms, is the blood from all of your organs that are not useful for fighting or running disappears. So you don't have any blood in your head or in your stomach. That's why you get butterflies in your stomach. It goes to your arms and to your legs. Great. But clicking the mouse harder is not going to make the trade work, nor is it going to get you a better trade. So what it creates is this tunnel vision where you lose perspective of trades. And so when you fall into this overly emotional state, this heightened state of fear, of uncertainty, you will lose the ability to control the thought process on the trade. This is why having a process and a plan behind a trade that is clear before you get into a trade is crucial. Because once in, you're now into the realms of combating this heightened emotion of essentially danger. And this isn't bad. That having heightened emotion, so sort of increased arousal or stress or however you want to phrase it, is not necessarily a bad thing. This can create a kind of flow type state where you're in tune with what's going on because you have a level of focus that is necessary. If you're too calm on a trade, then you don't really care about the outcome. And so whether it works or whether it doesn't isn't massively impactful on your emotional state. And so therefore this can create losses over time. But because they're not losses that feel uncomfortable, it's easy to let them go. And so one thing to be taken from that is if you're finding that very frequently you're in a trade and it feels really comfortable and you don't really care about the outcome of it, you're kind of like, well, I'm in, we'll just see what happens here. That's an indication that you're basically down here. You're in a suboptimal zone. And one way to get out of that is quite simply to increase your size. It's telling you something. It's telling you that size can be increased now and you want to bump that up so that it does create a more optimal zone of performance. You do have a necessary focus, but you're not into this uncertain, like panicked stage where you lose focus, you become more fearful of everything, you start doubting trades, and this has knock on to future trades because it's hard to get out of that so easily. You're in that zone, and as soon as you're faced with a similar type of pressure of situation, you immediately try and do the same thing and get away from that. And this explains then partly why we are willing to play games of chance, closed games of chance that theoretically have no expected value to them. There is no winnable aspect to these games, yet people are still willing to play them. The reason for that is the emotional side of things. People want that heightened sense of uncertainty because there is a thrill in it. This is why people go to theme parks. This is why people do extreme sports, because there is a thrill in it, and that sense of sort of increased adrenaline is not a bad thing. It enlivens people. So people are willing to pay for that, even though the overall value is not good. And this then is what effectively comes down to the underpinnings of prospect theory, which you will come on to once you understand utility. What utility is about is trying to quantify that emotion. So this is then looking at the value of things and then the relative emotion to them as well. I mentioned utility already in terms of my example of a lottery syndicate and protecting utility, protecting your effective satisfaction. Now, what traditional economics tries to do is to create a kind of almost unit of utility, if you will, and a sort of scale of utility. Now, the theory is that there is a linear relationship in utility between things gained and the increased satisfaction that you gain from them. Theoretically, if you have £1, you are happier. It's not directly money equals happiness, but the idea is that gives you more satisfaction, it gives you more options, it gives you more things to do. Great. So on that basis, £1 more on top of that is equally good. And conversely, losing £1 has the same level of devalued utility as losing £10. That would have 10 units of utility loss, in the same way that losing £1 has 1 unit of utility loss. But the reality is not that. The reality is that utility really is a diminishing curve. That your utility grows and then tails off. That more money, if you will, does not create more happiness. More money, in fact, realistically makes very little difference once you pass the point, and that point is different for everybody. So this is your utility in reality, and this is the theory. And that's where the problem lies, because it's very hard to then define why your utility does tail off. And that also explains then why traders are willing and able to make decisions that don't really, or in a rational sense, don't make perfect sense. They are essentially irrational. An example of this would be a trade that theoretically is highly likely to win. People are not willing to stay in that trade, and they will accept a smaller win on the trade simply because the utility loss to getting out is greater than the utility gain of staying in. So it's that matching that needs to be considered, as well as just simply, if the probability is higher of a win, well, surely you should stay in the trade. And that goes back to that concept from rational choice that we discussed. So, non-rational decisions can be justifiable in order to ensure against negative utility or drops in utility. Take, for example, once you reach this point, once you have that diminishing growth in utility, well, an increase in P&L, an increase in your performance is not going to add a great deal to this. But a knockdown in your performance can turn you back down the curve quite quickly, and that drop to there is quite significant relative to this drop to here is virtually nothing. That's the way you have to try and think about it, and that explains one of the basic tenets of prospect theories, or prospect theory I should say, that basically losses are perceived differently to gains. So this skews the way people perceive an outcome. Essentially, a loss, not perfectly proven, but in rough terms, a loss is felt twice as bad as a win, in the basic sense. So therefore, given the choice of a loss, or the possibility of a loss, people are not keen on that. And this is an important distinction to make. Traders are loss averse, they are not risk averse. This goes for humans generally. It's not just traders, but humans are not risk averse. They're happy to take on risks, but they're loss averse. And that loss aversion relates to the prospect of what the loss is. I'm going to give a couple of examples in a minute, and what I would suggest is I'll explain the examples, pause the video, think them through, and then restart. And so I'll give them I'll give the explanations behind them and the sort of the thought process behind them, and it starts to give a good example of prospect theory. Ultimately, what influences the decision and your weighting of a decision is the prospect of the outcome. And so to give a little bit of an example here, that as the chance of a loss increases, so as you move towards a loss, your utility drops very, very quickly. So in fact, I've done these the wrong way around. That as you move to a loss, so these two need to be switched over. As you move to a loss, your utility drops extremely quickly and then tails off. The further losses really don't make any difference and won't negate your utility any further. Whereas with a win, winning increases, but that then tails off very quickly. So you have two different curves here. The losses are felt very hard, very fast. Wins are felt positively, but these tail off much quicker than a loss. What this does mean is that because of the steepness of this curve, the possibility of a loss is still weighted relatively highly, because the prospect of getting to a win quickly is something that people are happy with, and they are very keen to get hold of. So people are willing to take risk in a situation that has a very low probability of actually winning, because the utility of the win is very high value. This is the example of a lottery. People are willing to take risk on a lottery, despite the fact that from an expected value perspective, this makes no sense. Similar to playing roulette. People are willing to take that risk, even though they can define the odds and they know that this doesn't make sense over time. The prospect of a small risk, or even a small risk in monetary terms, to a big win in monetary terms, the utility of that gain, or the kind of the status boost of that, the ability to say, I got that win, outweighs the fact that the risk, in fact, is very large based on the expected value of the trade. And people don't look at things from expected value perspective. They don't weigh in the odds of what's going to happen. They look at the prospects of the result. This is why so many traders get into trades and they look for what I call the hero trade, the trade that's going to go and go and go and go. They look for that because the prospect of that is great. The satisfaction of getting that trade right is wonderful. That's why people look at it in that way. And don't get me wrong, I've done that. I've been down on the day. You're down, you're thinking, right, how am I going to get this money back? And the amount of trades that I've looked at when I'm down and thought, do you know what? This is worth 100 ticks. Where every other trade that I've been looking at recently, I've not thought is worth 100 ticks. And that's not to do with the fact that I really believe it is. So the probability of this being a win, the expected value of this trade is very low because realistically it's not going to happen. But the prospect of that win, of the recouping that loss in one big go, is very attractive. And this is what allows traders also to take an outsized risk when they're down. This is why people, once they're down, start to risk more and more and more, because they get to this point where it doesn't affect your utility a great deal anymore. Your utility doesn't continue to drop as your losses get worse. So people are now willing to take bigger and bigger risks because the prospect of getting this back outweighs the downside utility of losing any more money. And you see this with people's stops. So they will have a point where as soon as they pass that point, let's say they have a soft stop at 1,000 and a hard stop at 2,000. If they pass 1,000, the utility of hitting 2,000, it doesn't make a great deal of difference. Therefore, they're willing to risk another 1,000, i.e. double their loss on the day for the prospect of recouping the first 1,000. Because the prospect of the recoup is greater than the prospect of the loss. Similarly, this is why people stop pushing it when they're up. Because the prospect of of going backwards down the curve, i.e. falling down this slope, that's a much steeper drop than the utility gain of continuing along that curve. Remember, these two need to be swapped over. Apologies for that. So, on the back of that, this leads us to what's called a certainty versus possibility principle. I'll explain that in a little moment. And that explains basically the slope of the curve. The certainty idea, that as something becomes certain, people are essentially willing to give away part of the payout for a lower amount to be certain of getting it. I.e., they would prefer a lower payout, even with a high probability of win, to the risk of losing, even if the chance of losing is extremely small. This is the concept of insurance. Likewise, possibility principle, when the possibility of something is a high payout, but the probability is low, people are willing to overweight the value of that and aim for something that has a high payout despite the fact realistically it's not a viable trade. This is why expected value is so important. The other aspect of loss aversion, we talked about this in risk management, is the concept of endowment principle or endowment effect. When you have something, the cost of losing it is felt much worse. If you don't have something, say you haven't bought something and the price of that item is rising and rising, it's much easier to look at that and say, well, I didn't own it, so it's fine. But when you own something, you naturally put a very high value on it to prevent the necessity of losing it. The problem in trading is that owning the trade, having the position, cannot in any way influence where the market's going to go. And so then you end up in a situation where you assign a value to your trade, to your position, and the market's trading here. You can't argue with that. And that's what makes it hard for people to get out, because they say, this is the trade, this is what it's worth, but it's not, it's down here. And as long as you won't accept that, because the endowment principle says, no, this is what I've got, you won't get out of the trade, and that again causes losses. You have to be willing to view every situation, every position, and the money in your account or the realized profit on the day is tradable. And as long as you view it as tradable, then it doesn't fall into the endowment effect. You don't believe it as owned, it is there as tradable, and so therefore can be used to further produce more winners, basically. That's the concept of loss aversion as well, which relates to the certainty principle. That a higher net result including a loss, even if that is a very low probability, is not as favourable as a lower result with no loss. i.e. if you can have 100 ticks with a 99% chance, theoretically the only price that you should be willing to get out there that's less than 100 is 99.5. That's where you should get out. But most people would be willing to get out for 90 or even 80 ticks, because that, once you've got to 80 to 90 ticks on side, the certainty of being able to bank this now, even though the probability of reaching 100 is almost certain, to mitigate that 1% chance that it's not going to work, effectively people pay maybe 9% or 10% of a trade, or 9% or even 19, 20% of a trade to make sure they don't lose that 1%. Rationally, that makes no sense, but in terms of managing your utility over time and managing the effect of that, it can be worth it. So cutting a trade short, if it starts to turn just before reaching target, has some degree of value to it. I'm not saying you should always be doing that, and certainly you don't want to talk yourself out of trades at the first sign that it's not going right. But what you don't want to be doing is getting very, very, very close to target, stubbornly sitting there for one more tick and then not getting it, because the downside impact to your mentality of that is much worse than the upside of getting that extra tick. Theoretically, you should stay for it, and that's the rational thing to do, but the value of that from a utility perspective to your psychology going forward is not very high. So justifying getting out of trades early. Right, prospect theory in a couple of different examples. So, certainty principle. This was something I was actually listening to on the radio a little while ago, and I thought it was a great game. I thought this illustrates it perfectly. So remember, have a think about this, pause it before I give an answer to it. It's a radio show, and basically on the radio show, there was a daily prize. You answered a few questions and they gave you a prize. Or you had a choice. You could swap that prize for going into a draw for £1 million. So, on the basis of that, I'd like you guys to think about, what information do you need to make this decision? How much money then also would you need to be offered as a prize to not swap? And then when and why do people make the irrational choice? Now, to make this a little bit easier, because being able to answer these is important. So if you can answer that, that's very important, because that shows that you're understanding the problem and the way to think it through. Now, in terms of what information you need to make the decision, you need two things. Crucially, you need one thing really. One thing is the number of people going into the draw. Because if you know that, so if you know how many weeks this is going to play before they do the draw, then you can make a decision on the value of the ticket, which essentially is what you're paying for. So there were 25 weeks of this. So 25 weeks, and then there will be a draw for £1 million. So this now makes it very easy to know what the value is that you should swap at. Basically, you do 25 or £1 million divided by 25, which gives you 40,000. That theoretically is the value of a ticket. So, rationally, the daily prize, if it is lower than £40,000, you should swap it every time. Because the probability of winning more than that is there. The value of this is there. That effectively, everybody, all 25 people, if they all join the draw, their tickets are effectively worth 40,000. If you did the draw 25 times in a row and you paid 40,000 for the ticket, that's about how much you should win on average over time. Now, the difficulty of a decision like this is rationally that's what you should do, but this is a one-off chance. So now this brings in an extra factor, and this is the prospect theory. That the reason people make the theoretically irrational choice is they can bank some money now that they didn't previously have, so that is a boost in their utility. So now they have a new base rate that they now have. Let's say the daily prize is 5,000. You've now got £5,000. This effectively increases your base rate. So now the idea of losing £5,000 is not a comfortable decision, despite the fact that the value of that is really 40,000. You should gamble it. But the utility loss of gambling it puts you off it. That's why people won't take this trade on. That's why most people make the irrational decision. Now, over time as well, you should be more inclined to gamble, because as people say no and take the money, there will be less people in the draw. So the less and less people in the draw, the greater chance that you have of winning, and so therefore the value of the ticket goes up and up and up and up and up. That's the way to try and think about it. But the certainty principle of being able to have something now with no chance of a loss, despite the fact that gambling it for a chance of a loss but a much higher payout is not attractive. And that's the idea of certainty principle, that if you have something you'd prefer, or you have something offered to you now at a certain value, you prefer to get out of that and not take the risk. The idea of endowment principle, it relates to this 5,000 because you view that as owned rather than as a choice. The endowment effect comes down to you having something. So take, for example, you have a coat. You've just bought a coat for, let's say, £250. This is your coat. What's the value you place on that to sell it? If I said I want to buy your coat off you, how much would you sell it for? Chances are, even though it is a second-hand coat and maybe it's a year old, you'd probably say not far off what you paid for it. What this does is this protects you from having to do that deal, because I won't pay £250 for a year-old coat that you only pay £250 for. This protects you. I might be willing to pay 100 for it because I know it's second-hand, I know it's old. So I'm willing to pay 100. Therefore, you don't have to make that transaction. And this is what people do with the P&L that they have. They've got it locked in, and so they're like, right, I've got £1,000 of P&L for the day, I want to keep that. So effectively, that £1,000 you have, you actually value at maybe 2,000, because that then prevents you from needing to, or even considering risking that in any way. One solution to this is to give yourself a trailing P&L stop. Now, what I would be doing there is not trailing it in a linear fashion. The bigger your P&L gets, your stop shouldn't follow it in the same way. So your stop should grow on a linear scale, your P&L can grow on a log scale. So why I'm suggesting for that is that, let's say your P&L goes from 0 to 1,000, you move your stop to 500. What I would then be doing is making sure that your stop does not trail by 500. You don't want it to trail by 500. You perhaps make your stop half. So now your stop goes to 1,000 when you move up to 2,000. And then you move up to 3,000. I'd only bring in the stop up to, say, 1,500. So your P&L doubles, your stop still goes up by the same amount. This gives you the ability that as your performance is increasing, as the amount of money you have grows, more of it is tradable. That way, you have more ability to make more money rather than constantly limiting yourself. Because what that implies is you're now going to have to create a linear growth in P&L rather than opening it up to a more exponential growth. And that's something humans are not very good at grasping. People don't grasp exponential growth very well. And so they always assume linear growth, but your P&L can grow at an exponential scale on a daily basis. Over time, month on month on month, it can't. You can't constantly increase by a certain percentage month on month. But on a day, if you can get yourself up 1,000, you could get yourself up 2,000 or 3,000. And that part of the growth scale is quite quick. And so you'll see that traders will move through the gears, if you will. That people can make it's a steady move up to, say, 500 to 1,000. People, once they get over about 1,000, have the capacity to make 5,000 very, very quickly and onwards. And it's then once people get to the ability to make perhaps 100 to 200,000 on a year, that then that growth phase starts to tail off a little bit. So the sort of your performance growth is a bit more like that. This phase is hard to start with. Then your exponential growth comes in, and you're able to go from the ability to make, if this is your daily P&L, from, say, 100 to 1,000 is very, very slow moving. 1,000 to 10,000 can be much quicker, and 10,000 to 100,000 equally can be quite quick, or at least 10 to 20,000 on a day can be quite quick. To consistently do 100,000 now requires a different skill set. It's not about narrowing skills gaps, which you've talked about already. It's not about narrowing skills gaps. It's about finding other ways that you can perform in order to build that size up. A good example of this, people don't grasp exponentials very well. Easy example, I'm sure most of you probably know this one anyway. If a lily pad doubles in size every day and it takes 48 days to cover a pond, how many days to cover half the pond? Most people instinctively go 48 divided by 2, 24. The answer, of course, is 47. because it doubles. So the day before it's covered the pond, it's half the pond. So that's the concept there. And it's something that people don't grasp very well. And people always fall to an automatic response as well, which again leans on that kind of emotional side of things, that you answer the quick question: does this look dangerous? Does this trade look like it's going to work? Oh, don't know if it does, better get out of it. And that's the quick response that people have to any situation that's uncomfortable. This explains the idea of prospect theory and decision weights. What it explains then is, as the probability of something grows, your decision weight, i.e. the willingness you should have to take the trade on, shifts, and it has a bit more of this sort of concave, convex curve to it. That what happens, that when the probability of gaining something is very low, people are willing to seek risk. If you have a low probability of a gain, people are willing to seek risk because the size of the gain is attractive. So they overweight the value, because what they're not doing, they're not looking at the value of the trade, the probability of getting it, they're looking at the value of the gain. Likewise, when there's a high probability of a gain, people are risk averse. They don't want to take the risk to get that because they see the downside of that, the loss of the situation, as much more of a negative impact on them. And so then, again, they're not keen on it and they're happy to step away from it, unless it's a situation where it's an almost absolute certainty. So when you have low probabilities of losses, what happens is people are risk averse in these situations. You have a low probability of a loss. This is the idea that you have a low probability of a win and you overweight it. But when you have a low probability of a loss, i.e. you're up here, extreme high probability of a win, people are willing to pay a high price, i.e. give this up easily, as long as this alleviates the risk of a loss. So it's that loss aversion type idea. So insurance is a great example of this. That you've got a low probability of a loss. When you insure your car, for example, against being stolen, cars don't often get stolen. So you pay a high price per year. You know, I pay £1,000 a year for car insurance, for example. I pay a high price for car insurance relative to the probability of actually losing my car. Now, that doesn't really make a great deal of sense, but there's a regulatory issue here. You have to have car insurance, so you have to buy it. But in terms of the value of this, I'm actually paying a very high price to mitigate an extreme low probability. But it does solve a liquidity issue. That if my car does get lost, or gets stolen, I now have lost out of the value of my car and have to find that money again to buy the car. Which is a problem because it's a large amount of money, so you've got to go and find that. And the insurance will pay you. So what effectively you're doing is you're paying a high price to insure against a low probability because the cost of the loss is something that you don't want to entertain. And that's what happens up here. That's why people undervalue situations and get out of trades easily, because the cost of the loss is something that you don't want to face. So therefore you insure against this by getting out of the trade. Right, this explains as well why people are keen on moving stops to scratches. Now this does not make sense. Because what this is doing is this is mitigating a loss at the first possible situation. At the first possible chance to mitigate a loss, you're now paying a really high price. And the high price you're paying comes out when you look at the probabilities. People think of it as creating a free trade, i.e. you can't lose. Great. You can also not lose by not putting a trade on. People see it as protecting themselves. They get out of a little bit, they move their stop to a scratch, so they can say, okay, well, at the worst, I've now got a situation where I'm going to make a little bit of money at worst. The problem with this is the other side of that, of what you're giving up to do that. And what you're giving up is the potential of the trade. Now, if you think about a trade in really basic form, any trade essentially has a 50-50 chance. Because when you buy, let's say, the market will go up, it will go down. So 50% of the time it will go up, 50% of the time it will go down. Granted, you can skew those probabilities through your analysis, which makes this even worse in some situations. But what you've got to think about then is if you're going to scratch trades, the logic of this doesn't work. Because of the 50% of trades that are winners, 50% of those now do win, 50% of them are a scratch. So actually, of all of your trades now, if you assume that it's a 50-50 probability of them working across the board, you're actually only winning 25% of your trades. You still lose 50% because when they go wrong, you get filled and it hits your stop. So now, the winners have to be double the size of the losers. That also increases the chance of not winning, because to go twice as far as a loss implies a greater chance that it might not, because you've got to go twice the distance. But more to the point here, what you're losing out by scratching a trade, and particularly when you've done your analysis and you can say, do you know what, this has a high probability of working. What you're doing is you're getting out of a trade at the exact point that you thought you should be in. You thought it was a buy, you think it's a buy, market goes up, market goes down, and now you sell it. That makes no logical sense. This comes back to that kind of idea that you can't prefer to buy and rather than to be flat, and then given the chance, sell rather than buy. That makes no sense. So rationally, it makes no sense. And also what you're doing here, without ever being proven you're wrong, you are giving up this. That's what you're losing. But because you don't actually lose that, it doesn't affect your utility. And so you don't see this as an issue. But the reality is, the opportunity cost here is vast. And the problem is, over the long run, this burns you. Because what you end up doing is scratching a load of trades that don't need to be scratched. And that would be a positive growth in performance that would easily mitigate some of those losses. That's the problem. That's why scratching trades does not create a free trade. It doesn't make sense in general terms, in rational terms. There are situations where a scratch is a viable choice and a realistic choice. And these are situations where more it is coincidental, or a situation where you have taken an educated punt, if you will, and it's not worked. That's a scratch. A trade where you've hit some news and the market does not do what you expect, equally, that can be a scratch. They're fine. Do the scratch. That's perhaps the best choice you've got. If ever you get into a trade and then you're suddenly thinking, this is a sloppy trade, I have no reason to be in it, scratch it, get out, no reason, get out of the trade. So let's go and have a little look at an example. If you have a situation where, for example, you are short above the breakout, this is a viable scratch opportunity because you should not be coming back above the breakout. That's a situation where you can say this is an acceptable scratch. Mostly because with a trade like this, coming back to your entry point has invalidated the breakout, and so therefore you are wrong. And coincidentally, you are wrong at the point that you were in. And this comes down to the fact that where you were in, you weren't necessarily right until it broke the low. Once it breaks the low, now you're right. So your point of being right is here, your point of being wrong is here, and that's when you can scratch a trade. That's acceptable. But you don't want to be scratching trades at the point where you are still right. If you'd sold it on the break here, and this bounces back, scratching that is a terrible idea. Put yourself in the shoes of somebody who's not in, it bounces back, what are they doing? Selling it. So don't be the liquidity for them. Because if you try and buy it when it comes back, you are the liquidity for all the other people who want to sell it. That's where a scratch is not a viable choice. So a little example of a bit of thought process within trades, and this is quite a common thing to see. That what will happen is that people taking an entry down here will look at this trade, and this is about thinking about whether you should be in, out, or scratching a trade. Your target is a new high. So this is the objective on the day. Buy in the pullback, new high. It breaks the top of the range, doesn't go for a new high. Okay. This isn't a reason to exit, because the possibility of this working is still absolutely there. So there's no reason to be out of this trade here. So you're looking for more information, and the information then changes the probabilities on the trade. Once you get this failed break, the reason being because this one does not even reach there, as in the top of the previous high, previous break, then you can say, I can get out of this, that's a viable exit. Because the probabilities have changed. No longer does this look likely to go higher. It's had one chance and failed, okay, you could find more buyers on this. Now it can't even get there and falls back below this high. You can get out of that. Certainly, once you break this low, now you can get out. You don't need to stop on this. You don't, as in you don't need a scratch on this. By the time you get here, you know that the trade's not viable, and you know that this is a trade you shouldn't be in. So get out of it. But you should be out already. Often you will have enough chances and reasons to get out before you get the scratch than there are reasons or the need to scratch a trade. Likewise, if you played the move down, this is not one to scratch. This is a test back. That's not a reason to exit. It's a test back to the level. What are people going to do? Sell it there. Put yourself in someone else's shoes. You're going to sell it there with your stop above that high. There's the trade. So there's no reason to not stay in the trade. This is one where giving up for a scratch here, you are giving up that much. And when you compare it in that sense, that now is very, very tough to take. That is around about a 60 tick move. And by scratching the trade, you've effectively lost 60 ticks because you had all the potential to make it and there was no reason not to make it, but you talked yourself out of it. Targets reached. Retest of level, that's a decent place to sell. Again, you can place your stop above that low. That all makes sense. No reason to get out of the trade. Breaks below these lows, it's a confirmed move. This shouldn't come back. When it does, you can justifiably exit this. Again, never needing to scratch this, you get shown that it's not working. When I say it's not working in the way that you expect it to work for this situation. This situation, your expectation is this is going to go and break the low now. When it doesn't, and it comes back here, the probabilities have changed. What could happen from here? Well, it could come back, show that this is a bit like this, and break higher. It could trade sideways. It could go down eventually like it has done. But that information here is not available when it bounces back here, and so there's no reason or justification to still be in that trade. That's the way to try and think about it, and think about the probabilities as the trade goes on. Next bit is prospect theory and volatility. When volatility occurs, your risk-reward structure changes. Reward increases quite dramatically. Your risk doesn't have to. Remember, you control the risk. You control the amount that you are going to risk on any trade, i.e. the size of the loss. Now, the potential of a move is still there. And the other advantage in high volatility is that there are more opportunities. The problem is, when you increase risk, loss aversion sees volatility as increasing risk in both absolute and in isolated terms. Now, in absolute terms, risk can increase because the size of a loss on a trade can increase. So you could end up with more losses of larger size. But that doesn't factor in the payout on trades as well. And it also sees things in isolated terms and looks at them and goes, oh, this could be a bigger risk. And so what people try and do to mitigate this is they keep a standard size target on a trade. They keep a standard sized stop. You cannot do this. Having a standard target, let's say a 20 tick target on a trade, when volatility increases, what you're doing is not accepting or not taking the potential out of a trade. So what you're doing is you're limiting your payout. And the problem with that then is if you always look for, say, a 20 tick target, as volatility increases, naturally the size of your stop, so the red line, will break the target. Because to stay in a trade when volatility is that high, you need to have a larger stop. But the payout can justify that. Yes, your stops can grow, but if you look at the size of the stop relative to now the size of the payout, that is a much bigger proportional difference. That makes a huge thing. And that's where volatility is not necessarily bad, but the prospect of losing in volatility because it feels like your losses are bigger, but they're not then weighted against the other side of things. Everything has a probability attached on the converse as well. If your losses are growing, that's okay in terms of size of a loss, as long as the size of the payout is growing at a greater rate. That's the crucial thing that you need to understand when volatility is increasing. Having a standard tick target when volatility increases is one of the worst things you can do, because what that does is that reduces your ability to make money over time. You'll still get burnt with 20 tick stops, but you're only making 20 ticks of profit, where really you could be making significantly more. Take, for example, a trade like this. Low volatility environment, high volatility environment, much higher volumes going through. This is pre-cash in high volatility. This is during cash in low volatility. You're struggling to touch 2,000 contracts on any 5-minute candle here. Here, pre-cash, you're over 2,000. Frequently, you're over 800. Whereas here, during cash session, you're still struggling to make 800. Big difference. So, with the higher volatility, you've effectively got the same trade here. You've got the same size of risk. So on a trade like this, playing the trigger, break here, you've effectively got yourself around a 20 tick risk on this trade. On this one, similar thing, about a 20 tick risk. But the difference is the reward. Because volatility is higher now, you've got a much bigger payout on the trade. And even if you play it from the trigger, down here, you've got a 30 tick risk for a 100 tick payout. Whereas here, you've got a 20 tick risk for a 60 tick payout. The risk reward's the same, the payout is much bigger. So it's an acceptable increase because in nominal terms, you are making significantly more. The risk is only 10 more ticks. The payout is 40 more. So if you compare the increased risk to the increased payout, there's a massive difference. It's 4-to-1 difference there. That's what volatility does for you. So in terms of the risk reward on trades, that risk reward ratio may not change, but the difference in payout is significant in nominal terms. You're risking $100 more for an extra 400. That is the important aspect of understanding volatility and how that factors into the risk, the reward, and the prospect of a trade. This is why you shouldn't fear volatility. It's about managing volatility. The other thing to understand with volatility, though, is patience versus frequency. What volatility does for you is ramps opportunities. So you get many more or a higher frequency of opportunity. That's one thing. So in absolute terms, your opportunities increase. So low volatility, there's your opportunities, your purple line. High volatility, there's your opportunities, the purple line. So many, many more chances to trade on a day. You can afford to be patient though. Quality opportunities will also increase. But they'll increase in a similar proportion. If of all opportunities, 50% of them are quality, when opportunities increase in number, you're still going to have the same proportion of quality opportunities. So what this means is that in absolute terms, you are going to dismiss many more trades when volatility is high because there are more opportunities. But the payout on the quality opportunities is still there. So the quality opportunities offering you good risk reward and reasonably high frequency payout is still there. And the good advantage here is you've perhaps now gone from 5 when volatility is low to 20 when volatility is high. So you've effectively got a week's worth of opportunities per day of quality opportunities. So as a percentage of the number of available opportunities, you're not taking any more. But what you're doing is basically compressing a week's worth of trading into a day. You dismiss 20 trades and take 20, great. Whereas when volatility is low, you're dismissing 5 and taking 5. So it feels like you're constantly shot opportunities that you can take. But this is because there's always more. Be patient when volatility picks up. You don't need to jump into everything. But when the quality opportunities are there, the payout's much bigger, the risk does not grow in the same way. And that's the whole concept of exponential growth as well, that people don't always grasp.